Luke Beckman from Central Valley Ag is our corn and soybean market analyst this week. The USDA's latest monthly export numbers revealed a disappointing November. U.S. corn shipments were 18% lower than the previous November, and soybean exports were down 15% from November 2014. A strong U.S. dollar has continued to affect international ag trade, but will volatility in the U.S. stock market change that? We discussed that when we talked with Luke on the afternoon of Thursday, January 21st. Recap for me what's happened so far this year in the U.S. stock market.
Well, it hasn't been a really hot start. U.S. stock market, Dow Jones is down 8 to 9% depending on the day. We've had some pretty wild intraday swings. Just economy in general, you kind of look at what's happening with crude oil, and it's just commodity-wide, everything's been pretty negative. So certainly extends into the stock market. Globally, China's kind of in the same boat, and as China goes, the rest of the world seems to be following right now, just because they're not as hungry as they used to be.
Let's talk about both of those things, China and oil. Let's start in China. How real are the concerns in China?
Well, I think if you look at things from an ag sector, things are probably okay. I mean, you look at soybeans, their version of the USDA essentially expects Chinese imports of soybeans for their marketing year to actually be up about 8% for 2015-16. So they're buying soybeans. They're hungry for those types of commodities. It's some of the other areas that you extend into, how they utilize copper and some of those other raw materials. That consumptive demand seems to be down a little bit. And so that trickles into the economy in a lot of areas. And it comes back to the U.S., it comes back to producers in South America for things besides, just corn and soybeans.
We're talking on Thursday. It was a good day for oil today, not so much yesterday. What do you think its impact is?
The oil story really extends into a lot of different things. We're down 20 to 30% on oil, just depending on the day this year. We're trading below $30 a barrel. Pundits are talking about, that could go as low as 20. We could actually slip into the teens. A lot of places are not making money with crude oil where it's trading, but you have a lot of these Middle Eastern countries where your GDP is so dependent upon oil. Regardless of the price, you're going to crank out as much as you can to generate as many dollars as you can. So we're just sitting on this glut of oil. Where it comes back into the U.S. economy and to farmers is certainly going to be how it impacts ethanol. That's something that we want to talk about. Spot margins in the ethanol industry have started to slip, and maybe we're starting to see that as ethanol production wants to start backing off a little bit. Now, while that might be a negative on the ethanol industry if crude's going to stay as low as it is, it's provided a couple of wild cards, if you will. First of all, energy is cheap. So if you're a producer and you're looking at, even the price of diesel fuel and what that's done and what you're able to contract or maybe fill your tanks at currently has certainly been positive. Secondly, with crude oil being a poor performer and the stock market being a poor performer so far this year, you've got to think that the Federal Reserve is probably taking a look at interest rates. Initially in December, we ticked the rates higher by 0.25%, and the intention is that we're going to kind of stair-step that up as we go through 2016. Obviously things aren't going super well in 2016 so far, so you probably have to look at that, and does the Fed deviate from that plan? If so, we probably had a lot of initial strength built up even into like the U.S. dollar. And if we're going to deviate from that plan, do we see the dollar soften a little bit? And if so, that's certainly positive for the ag sector.
Where are corn and soybean exports at right now?
When you look at soybeans down about 11% with sales and shipments so far this year, we started out slow. We've caught up a little bit, but that story's about done. I mean, our window to export soybeans is about over. You look at like corn, we're down about 20% there. In terms of what we're exporting. One thing we really want to watch, Jeff, on the exports for corn is going to be Brazil's second crop. Their safrinha crop is going to be very important. Their soybean crop is late. They got into the fields late, which is going to back everything up a little bit. So will that impact their second crop corn? Will that create opportunities for the U.S. to catch back up in terms of exports and maybe cut into our carryout a little bit? We're going to have a good second half of 2015-16 in order to do that.
If you look at those three demand buckets for corn, right? Feed demand, ethanol, and exports. Is exports the one that's lagging right now?
Absolutely. It's a problem. The export picture really has the opportunity to swing that carry out, 200 to 300 million bushels either way, and we're kind of on the bad side of it this year. So far, ethanol production, feed demand have been very good through the first, quarter and a half of 15 and 16. So exports are to blame right now. If we could turn that around, or if there's issues in Brazil with what's happened in South Africa with their crop not being where it's at, we can start to pull back on the world carryout. The U.S. maybe has an opportunity to capitalize in the second half of this year.
All right, to close out, Luke, give me your price forecast for corn and soybeans.
I think that it's going to be fairly quiet. We have to watch what the fund short has done. We've picked up and added 20 cents to corn here since we made some new lows early on, and that's been positive. So if the funds can cover their positions, I think that you could see corn add another 15 to 20 cents, both on the old and new crop. So new crop pokes back above $4. That's probably something we want to look at. If you get the corn price on the board at a 375 versus March futures for the old crop, that's probably something we want to look at. On the soybean side, if we can flirt around that $9 figure on the board of trade for March futures, I think that's something that we probably need to look at. We get north of $9 futures on new crop soybeans. Maybe there's some different things we can do as far as putting floors in or looking at some other contract alternatives. But with where the carryouts are at, any kind of short covering by the funds is probably an opportunity that we want to take advantage of.